Welcome to today's webinar. Our topic for discussion is AI a threat to investment advisors or an opportunity? We will be joined by the founder and CEOs of both StockSnips and UX Wealth Partners, who I will introduce shortly. My name is Rebecca Wild, Managing Director here at StockSnips. And ever so quickly, I will just provide a quick disclaimer that the information presented today is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investment or investment strategies. These investments do involve risk and, unless otherwise stated, are not guaranteed. So our hosts, as mentioned, are Ravi and Kyle. If you both ever so quickly could just give us a 10 to 15 second introduction of what the firms that you both run does offer to our audience.
Sure. I'm Ravi Koka, founder, CEO of StockSnips. Sorry about that. Founder and CEO of StockSnips. I started StockSnips in 2016 with 3 decades of background in artificial intelligence, natural language processing, and the problem we were trying to solve is to see if there was a way in which we could convert news stories into a sentiment signal, which could potentially achieve alpha. We did extensive research, and I'm glad to report that we now have 6 years of history of for 5,000 UX equities, and we offer sentiment-based portfolios for investment advisors.
Awesome. And Kyle?
Good morning, Rebecca. Good morning, Ravi. Thanks for your time. My name is Kyle Wiggs. I'm one of the co-founders here at UX Wealth. Very brief background is spent 15 to plus years in the wealth management space. Really more on the TAMP side, the turnkey asset management platform space. And we started UX Wealth because what we noticed in the marketplace was the feedback that advisors were sharing with us around technology-driven investments and a better technology stack. Most of the traditional firms out there kind of reject it. And so a lot of the model marketplaces that you'll see at a lot of the traditional players are really all the same. The technology is all the same. And what ends up happening is ultimately it's the advisors, I think, that are becoming more and more commoditized. So we launched UX to really sort of challenge that status quo.
Wonderful. Yeah, both visionaries in the AI space in this investing arena. So that's great to have your expertise on this webinar for discussion. So again, just to quickly recap what we will be covering in today's webinar. So topic number 1, what is artificial intelligence and machine learning? How can we demystify what that means when it comes to investing? How can advisors leverage AI to enable the automation of previous tasks and also improve customized experiences? Will systematic AI-driven models deliver alpha? And how can advisors prepare and equip themselves to leverage AI and data analytics in order to drive more diversified offerings to clients? So Ravi, let's kick things off, given you've been around AI for the past 3 decades. What exactly is artificial intelligence and machine learning? Can you help us demystify what that means when it comes to investing?
The term artificial intelligence was coined by the fathers of artificial intelligence, who basically they were at Stanford, MIT, Carnegie Mellon, and what they were looking at was can machines perform human tasks? And these could be simple tasks like, for example, recognizing an image or understanding speech, or for example, in the case of robots, can a machine open a door? So these were some of the broad areas of research in the 60s and the 70s, and the breakthrough started happening in around the mid-70s when the first, actually my mentor at Carnegie Mellon came up with the first computer recognition of speech. And this involved understanding language, the grammar of language and basically the context in which a particular word occurs in a sentence. So a lot of that research was done, the phonetics, the parsing of different languages, and that's what is called natural language processing. That's basically machines reading text and being able to understand and interpret text. Machine learning and deep learning, these are, they came about later. These are based on models where basically machine learning is pattern recognition. So these are models which use various types of mathematical and statistical techniques to recognize patterns. And this is what they found to be useful, for example, in image classification. If you give the computer 1,000 images of cats and dogs, can it accurately identify a cat and a dog? And the basic premise in machine learning and deep learning is that you first have to train the algorithms. That means you have to first give it labeled data. Label meaning somebody actually says, this is a cat, this is a dog. Feed that data. The machine learns based on it. Basically, think of it as it reverse engineers the image and tries to recognize the patterns and basically stores that within the algorithm. And then when you start doing out of sample, it can accurately recognize new images. Of course, the accuracy it's almost, it used to be around 80-90%. Now it's almost like 99%. And that's because of what is called deep learning. Deep learning are more advanced neural networks that, and because of computing power and GPUs, what was not possible 30 years ago, you can really train these machines to very accurately recognize speech, recognize images. And one of the big applications of deep learning is in self-driving. As you know, when you're trying to do autonomous driving, the car has to recognize objects on the street and the distance and so on. So it's come a long way, and that's kind of in a summary. And there's another branch called robotics, which also involves motion as well as control, such as a robot, walking across a room and picking up an object and so on. And several successful robots. So several of the simpler human tasks are possible now for artificial intelligence to do the same tasks with about the same accuracy as humans.
Awesome. Thanks, Ravi. Some incredible applications for AI in this world that we live in today. So we obviously at StockSnips deem ourselves to use and leverage some of the most advanced AI. Talk to us about this technology and what the outcome is of this.
So what we did when we did the original research was, the first thing we did was, can a machine accurately read text? And so we took a large number of documents, SEC filings, 10K, 10Qs, and then we fed that to the machine. And there are challenges because the computer, the context is important. For example, is Apple a fruit or a computer? So the context matters. So we had to do a lot of training of the algorithms, and you also have to, first of all, recognize what are the entities mentioned in an article. And that itself is a tough problem. For example, the letter C, that could be the ticker symbol for Citigroup, or it could be vitamin C or something else, right? So these are some very tough challenges that we face. We've solved most of those problems. We have a very high accuracy of attribution. Now, once you read an article, break it up into snippets or sentences, attribute it to the right company, then the next problem is, okay, what is being expressed in the news stories? Is it positive or negative? And that's where we use machine learning. So we basically train the algorithms to accurately classify a sentence as positive or negative. And this is where we use deep neural networks, which are very, very advanced, very, very accurate, and we get accuracy as high as 92-93%. In this example, for example, in advanced micro devices, what we've done is we've taken all the news stories, and then this is showing you news stories in the last 30 days. And we've converted that to a score. What you see, 83.1%, that's sentiment score. That's a quantified score, which is basically, it balances out all the positive, negative opinions about AMD in the various news stories. We process from about 20 different sources, reliable sources. We do not process social media because the signal there is not reliable. And this, we do this for 5,000 US equities on a continuous basis. And what several studies, including a study done by Carnegie Mellon University, independent study, was that our signal, this continuous score that we generate, which is the daily sentiment for a US equity, is a very good proxy for investor sentiment. And in the last decade, people have seen that it's not just fundamentals that drive price behavior, it's also investor sentiment. And there isn't a measure available at the individual ticker level on a continuous basis. There are macro indicators like the VIX index, fund flows, and so on, which kind of, it's market sentiment, but not at the ticker level. And also those are not, they're not as granular as, and that's what several studies have found. So that's basically, you're taking news stories, converting it into a quantified score. You've created a time series data set that can be used with price and other fundamental data, and you're able to predict the behavior of a particular equity.
Fantastic. Thank you, Ravi. Very interesting take on how we use AI today. So, Kyle, you're the co-founder and CEO of a very successful firm that too is a visionary for the use and implementation of AI. Talk to us about some of your views as it pertains to how advisors can leverage AI to enable the automation of maybe previous tasks or also improve customized experiences.
Yeah, I think the biggest thing that we've seen in this year, we've really seen it play out, is a lot of the human-driven, models that we see in the other marketplaces. They come with human bias. So we enter a year and we have expectations. We have expectations around where interest rates are going to go, what the market is or is not going to do. I like to watch a lot of the economist forecasts coming, into each new year and then track those throughout the year. And what you find is that they're often not very accurate because of that human bias. And so what we're seeing with StockSnips and others is the ability to leverage technology, and as Ravi said, there's many different kinds out there, to really detect patterns that are not identifiable from a human perspective, and then put those to work in a very unemotional and unbiased way. And you really get a couple of different outcomes. One is you identify names and companies that you just would never have even thought to put in a portfolio. And then the other is the ability to manage volatility through periods like 2022, where we've got volatility in both the equity and fixed income markets.
Fantastic. Yeah. And, you make some great points there. And stemming from that, you obviously on your TAMP platform have many portfolios that are driven by AI, some of which obviously being StockSnips sentiment AI models. What are your thoughts on whether or not systematic AI-driven portfolios can deliver alpha, do deliver alpha, and where you kind of see the future of that being?
Yeah, I mean, it's become sort of the cliche term that I think a lot of people are using. So I think it's really critical to get to know the founders of the technology and ask, how are you applying artificial intelligence? Is it just, is it sentiment based? Is it something else? And then to understand sort of the behaviors and patterns of what is it that you're trying to identify? How are you trying to identify alpha within your portfolio? Because there's so many different ways to actually accomplish that, Ravi, as I'm sure you've seen throughout kind of your studies. And so what we do is we'll identify a particular need that we have in terms of the model marketplace. And then from there, what we'll do is we spend a couple of years, as we've done with StockSnips, and we'll seed a portfolio. And what we're really trying to understand through that process is what type of alpha are you pursuing here? And is that consistent and is it repeatable? It's one thing to say that the AI does it. It's another to watch it through multiple market cycles.
Awesome points, Ravi. Anything to add there?
Sure. I think the proof of the pudding always is, like Kyle said, AI has been around a long time and a lot of people have tried to build various kinds of models. The question is, can you consistently deliver returns, excess returns over whatever benchmark you target? I mean, AI doesn't necessarily mean that you always have to, beat every benchmark that's out there. You have to have a portfolio design, but whatever the design and whatever the goal is, you have to do that consistently. And that's what our extensive research has shown that AI-based news sentiment, if it is used as a factor in the selection of stocks, that seemed to be a lead indicator, and it had a repeatable performance in our back tests. And then we went out to people like UX Wealth Partners to seed and watch the live performance, meaning performance out of sample, not the back test, because as you know, past performance is not a guarantee for future performance. So you need to see whether these models are stable, consistent, how do they behave under different market regimes. I compare that to clinical trials. Before you introduce a new drug, you got to do extensive tests to see how it behaves, not just with one population, but different, the older people, people with high risk, and so on. So the same thing here. Model might work great under certain regimes, but let's say there's a rapid downturn in the market. What happens to the model? How does it behave? That's the experience we now have over the last 3 years.
Fantastic. And I think that leads us very nicely into, the review of one of the models that we offer here at StockSnips, which is the StockSnips MSDX Portfolio US Equities All Cap. This is made available on the UX Wealth Partners platform. And obviously, Ravi, to your point, we've seen some, a lot of market regime changes this year, some volatility thus far in 2022. How has the model fared in comparison to some of the benchmarks, if you want to walk us through the returns?
First, an explanation of where this chart has come from. This is from ETF Action. It's a software platform that UX Wealth Partners subscribe to, and all of the models are loaded in this platform, and they actually calculate all of the return risk statistics. So, and this has results from a back test, which is from 2017 to May 2021. And from May 2021, it's out of sample shadow trading that UX Wealth has done on this platform. And that's what these results represent. These are not audited results, and these are not necessarily realized gains. We do have some live portfolios, and we can provide that data separately, but these charts are model results, hypothetical returns. And you can see this model, what the strategy here is, from 1,000 large, mid, and small cap, we rank the stocks by sentiment, and stocks that are intrinsically high in sentiment, they come to the top, and then we also look at the change in sentiment, what we call sentiment momentum. Those are the two factors we use in picking the top 30, and this particular model picks that every week. Every week, the portfolio is rebalanced every week. And basically, if you go to the next slide, you can see it's outperformed significantly year to date, as well as the 1 year performance is significantly higher than the S&P 500 benchmark. If you go to the next slide on the return risk stats, you can see the alpha generated is significant, 6.65%. The most important thing that advisors look at is how did it behave in 2022 when there was a major drawdown. You can see that we are year to date, this is as of July, end of July, we're minus 2.81 versus minus, market was close to minus 13 or so. The standard deviation is higher, the beta is a little higher, so it does come with a higher volatility than the market. So that's the risk side of it. And the most important characteristic, as you can see from the up and down capture, is that in a bull market, if the market goes up, this will significantly capture a higher part of those returns. And on the downside, it gives you some downside protection. So it's by design, it's more volatile, but the reason for that is to capture excess return when it's in a up market. In a down market, it also behaves in a way that you don't have a major drawdown.
Awesome, thanks, Ravi. They're very interesting and impressive stats to say that this is driven by machines and it's been able to adapt so well to what we've seen this year. So moving on, I do want to, Kyle, I know you've got some interesting studies to speak to, but Ravi, first, if you have, any ideas how advisors can prepare and equip themselves to leverage AI and data analytics in order to maybe drive more diversified offerings to their clients, if you could provide us some quick thoughts.
I think advisors need to be aware of AI and its role in investing. Like Kyle said, if you just go after the ETFs that are out there and most of the model marketplaces, they're all the same. They're just different variations of several of the indexes. So you're not getting, as an advisor, you're not getting any diversification or anything new for your clients. So there is a demand out there. Clients are getting more knowledgeable. They know that there's more science, data, technology driven portfolios as opposed to the conventional index, passive ETFs. And that's the part, as an advisor, you need to understand it and be able to explain this in, layman's language to your clients, and also explain obviously the return and risk, because, that it kind of goes hand in hand. Every portfolio comes with a certain risk and return and risk profile. So important thing is to understand what is AI, how is it being applied? Like Kyle said, different applications. Is it used for ranking and picking stock? Is it for asset allocation? Is it for just risk management? So there are different applications. I think an advisor needs to be aware of all of these different applications of AI.
Perfect, thank you. And Kyle, I'm going to pass over to you now to kind of walk us through, given your relationship and you work so closely with RIAs, what you've seen is really driving the desires and the reasons why clients might work with certain advisors and why advisors pick certain strategies.
We have this internal saying that we often refer to, we call the cycle of self-defeating status quo, and we coined and trademarked the phrase really in just feedback from advisors. It was, if all the models and investments are the same and all the technology is the same, we've now got over 100 robo solutions that are available. We have over 220,000 financial advisors competing for a pretty small percentage of the overall population. And so how do you ultimately deliver better results, but also stand out from what's become a pretty crowded marketplace? And so we wanted to understand a few things, one of which was, as we read a study that was done by Accenture, and they talked about the new state of advice. And there were really 5 things that jumped to the top of the page from all of the clients that were surveyed in terms of why would you choose an advisor? And the first one, obviously, is investment offering. And so as you look at these, ultimately kind of string them together, they have a bit of a common theme. And a lot of it is underlying sort of technology. How do I automate and scale, giving more personalized advice? How do I offer better product recommendations than what's been pretty traditional and sort of status quo here for the last several decades? And this last one, which was interesting as you read more into it, is this always on interaction. And it's this idea that you can, through technology, always get access to your advisor, to information, and to ensure that the models that are being run are in effect always on.
Thank you. And then you've got this other study from Deloitte, if you'd like to share some takeaways from that.
Yeah, it's interesting. Reading through this and having a couple of clients that we know pretty well read through it as well. The study is worth reading. It's done by Deloitte. It's called the Rewired Investor Report. And as advisors now start to talk about utilizing technology that's more adaptive, right? Whether it's choosing individual stocks like StockSnips to identify alpha in a bull market, whether it's using technology to identify periods of volatility and de-risk a portfolio. When you explain it, as Ravi said, in simple terms to a client, more often than not, the response that we're finding is, well, I thought that's what my advisor was supposed to do. Right? This is how the average everyday person thinks. Well, yeah, that's what I'm paying you to do. And so their expectations are becoming pretty clear. And it kind of goes back to why they would hire an advisor. It's this idea of downside protection, more investment offerings than what's being presented constantly, things that are more tailored. And then the last one, which is what we're talking about today, which is this idea of science-based advice. And so when you put all these together and you kind of roll to the next slide, there was a great study done by Kaplan, actually, and they went to their College of Financial Planners, and the number one reason cited within their entire network for clients leaving was underperformance of investors, of investments. And the greatest concern of the advisors was investment performance. And so as we think about this, and maybe turn it to Ravi for his thoughts, we're just now starting to hear more and more about, the cliche term artificial intelligence, which can mean so many things, as Ravi's talked about. But it really started in the 1950s, right? The first kind of artificial intelligence. And so we're 70 years into this. And I would ask the advisors to think about two things. In 1952, we were introduced to modern portfolio theory. So 70 years later, really at the same time we were introduced to artificial intelligence, how has MPT really evolved and changed, other than we just package it now in different ways through things like ETFs? But look at how far artificial intelligence has come, and look at how far, isolate it to the last just 5 years, Ravi, how far it's come even since then. And as we know that so much of the data that the markets are now having to process and digest has really come within the last 3 to 5 years, I think what you'll find in the next decade is that AI will, I believe, far surpass what the sort of MPT and human-driven investments are doing.
Yeah, I think your points are extremely valid there, Kyle. Really great points. And Ravi, I guess if you want to chime in and add anything there, where you kind of see the future in terms of AI investing going.
Just to respond to Kyle's question, what has changed, in the last 70 years? So the sentiment was always there. If you went to Wall Street, people would be in coffee shops picking up, conversations, or they would read the Wall Street Journal or some other magazine and form opinions, right? So that was always there. So what's different is exponential growth in data, and it's like most of the data has been created in the last decade, and then the power of machines, GPUs and cloud and so on, the ability to process all of this data and to find patterns, which, it's almost impossible for a human to do. I mean, for example, we read 50,000 articles a day. So how many human analysts can do that? And then also picking relevant facts and deriving a sentiment. That's just one example. There's lots of other types of alternative data. And I won't go into all of that given time. The future, as I see it, we're just at the beginning of how AI is being applied, and there is a chance here that you could basically, modern portfolio theory, which basically says put your money in index and don't do anything, and that's several people have challenged that, and there is always arbitrage. The question is, how do you find that arbitrage? There are several problems to solve. What we have solved is converting news stories to an investor sentiment and converting that to a signal. So we call that MSDX, message sentiment decay model, because sentiment has memory. So to accurately figure out what is the right signal, because there's data and there's signal. So that's one problem that AI can solve, and we think we've solved that problem. But then there are other problems. For example, asset allocation. As market regimes change, sector rotation, growth to value, and so on, or for example, certain macro factors like inflation, etc. How do they impact? Do they impact all of the stocks in the same way? This is where I think AI is going to go to the next level, where the type of predictive models will get even better and better, and it's all going to be based on processing large amounts of big data and improvement in the understanding of how this data is to be used in building predictive models, and it is the holy grail. If you can predict that a particular sector is going to be doing better in on a particular day, you've got to win, right? That's all it takes. Like they say, right, you don't have to be right 100% of the time. If there's a hedge funds that are accurate 54% of the time, and that little arbitrage is sufficient to generate alpha. And as you can see, we are generating alpha. We're in the 4 to 5% range, And we believe that as we improve our algorithms, we can squeeze some more.
Awesome. Well, I think, Kyle, unless you have any additional comments there, I think that wraps up a pretty comprehensive insight view into the AI that we're using and how it's used in model management and also on your TAMP platform, Kyle. So I will kind of close this out now for the sake of time, but if anyone does have any questions, please feel free to reach out to us directly via LinkedIn, via email at info@stocksnips.net. We will be hosting more of these webinars of similar types, and we do look forward to hearing from any of you and all of you to provide some further detail. Thank you again for all joining, and have a wonderful rest of your day.
Thank you. If you, like I said, if you have questions, do get back to us.
Bye-bye.